And we are back, ladies and gentlemen. Welcome, welcome, welcome. John Johnson Signature Group, Exit Platinum Realty, and welcome back for another and our second episode in this new year 2023 of the Real Estate Keys. And I got a guy over here. Who's that guy that's over
Hey
here?
everybody, Joe does mortgages, NMLS 1925079. Hello everyone, welcome back to the show. Thank you again for joining us.
Yes, sir. Yes,
We
sir.
got an exciting show today, John. The
We got
first,
very exciting stuff.
first. This is a much different, much off topic that we've gone off from regular conventional loans that we've done since we started this programming.
Loving it, loving it. And I guess before we get into it, we want to introduce our viewers to a new kind of layout that we're going to be presenting to you guys. So we are the Real Estate Keys. So we deliver keys within the business that we hope and feel that you guys may be able to utilize, right? And we are going to focus on a set of keys, like a real set of keys, and we're going to focus on the master key. So the master key will be the main topic that we are going to bring to light and discuss and bring to your attention. And then we'll have other keys. So those other keys that will support that master key. So we'll be pointing that out in every single episode. So we hope you walk away with those key points, those master keys, those keys, if you will, as you venture off into your real estate journey.
Journeys,
So
love it.
hopefully that makes sense. So Joe, man, why don't you take us away? What are we looking like today, man?
Let's look at the rates. Everyone's favorite topics. Again, as usual, I am not quoting any particular bank's rates. These are not my rates or any other bank that I may be affiliated with. This is just an average. You can pull these rates up on your own at mortgagenewsdaily.com. You go to today's mortgage rates, and it's going to show you a breakdown of the different types of loans that are available out there and their rates that are connected to them. So you have your conventional 15-year jumbo, oh, yada, yada, yada. You can see where we are right now. Much bigger difference than where we left off, I think, at the end of the year, John. I think we were in what were we, 6.8?
Yeah.
6.75, somewhere around there at the end of last year. So it's been a dramatic drop over the last couple of weeks, in less than 30 days. All in good. This is all good news for future home buyers this year and the years going forward. So that's where we are with the rates.
Okay. Looks like we're leveling out a little bit, man. Getting back
to definitely
pre-COVID rates, man.
I'm not sure if we talked about it. You can Google it. All the experts tell you the same thing. Whenever whenever recession talk starts to come around, normally in past instances, the mortgage rates actually go back down. They start to adjust in a positive manner. So this is all based off the information that the experts have been providing over the last couple of weeks or the last couple of months, and it's working out in favor of the buyers.
Awesome.
Sounds like a plan, right? We're moving in the right direction. I love it. I love it. So today, what we are going to discuss, and this again is one of the, we've never talked about this type of loan or this type of product. We're going to talk to our investors, our current investors, future investors, potential investors that are looking to get into building a real estate portfolio. As you can, a lot of people tell you on Instagram, building wealth from real estate, which we all know is possible, especially here in New Jersey. I'm not sure if you've taken a look of downtown Jersey City in the last couple of years, John, but there is definitely some money to be made in that area. I'm just using that as one of the examples. Mm-hmm. I've seen it in Edison. I've seen it in Newark. I've seen it in Irvington. Yeah. You name it. New Brunswick. Multifamily houses, they're available, but when you start looking at those 3-4 unit houses, hard to find.
Yeah,
they're really hard to find. I had a call with a client actually about an hour ago, and she was looking to buy a 3 to 4 unit a 3 to 4 family house, which you can do with FHA, right? Only 3.5% down,
Mm-hmm.
in Sussex, right? Makes sense. South Jersey, exit 9, right? And I went on Realtor.com, and one house came up. All I did was select multifamily. I didn't put price. I didn't put any other filters. All I put in was the city or the county. Sorry, I put the county. Yeah, Middlesex. I got it right up here still. And one house came up.
Yeah, inventory is still, especially in that kind of market, especially in that kind of market.
And why I told my client, I was like, well, have you already found one? Because it sounded like she already had done some homework. She was just looking to get pre-approved. She goes, not really, but I didn't want to be Mr. Negative Nancy. I was like, 3 to 4 family, right? And sure enough, I was right. Why is that? Because a lot of investors gobble up those homes a lot faster, and they have more buying power than an individual that's looking to just buy something with 3.5% down, right? So how do these people get into these types of loans? All
And
right.
real
So
quick, Joe,
go ahead.
real quick, but before you know, take a deep dive into the master key, a lot of reasons why. Well, the main reason why a lot of investors, whether you're a first time investor, whether you're a seasoned investor, the main reason why you look at a 3 or 4 family unit to invest in is because number one, you're pretty much reducing the risk, right? If you purchased a 2 family home, which is considered an investment property, if one of those tenants moves out, now you're down to just one sole income to potentially cover all the expenses for that property. With a three
Absolutely.
family, you're chopping down even more risk because if one of those tenants move out, hopefully you still have 2 other tenants that are covering that mortgage. Four
Absolutely.
family, same thing. If let's say 2 tenants move out of a 4 family, you still have 2 tenants that are still covering the bulk of those expenses to keep that investment property running and hopefully still being green, meaning you're still profiting after everything has been paid. That's a
And I
key.
know,
That's a key.
and in Jersey, John, some of the counties, they kind of refrain, or they're not big fan of big multifamily property uh, type style houses in their communities, right? So from time to time.
Yeah, you do have some municipalities that have zoning restrictions
Right. Exactly.
on the kind of multifamilies that are built or the multifamilies that reside in an area. But there are plenty of other municipalities that are just a gold mine for your 3 and 4 families. It's just unfortunate now because the way the market is, based on the advantages of having a 3 or 4 family, like I just explained, that inventory is slim to none.
So that's usually the case. That's why I kind of knew when that person named that client named that city. I was like, it's going to be hard to find. But some of you guys, we may have you guys can put some information or put some responses in the comments. Some of you may be investors currently. You may have heard of this product before. It's not brand new. It's not just being reinvented. It's just starting to become a little bit more popular because of the type of credentials or lack of documents that you need to qualify for this type of loan. Okay, so what we're talking about today is DSCR loans, or debt service coverage ratio. What that means in a nutshell, in very layman's terms, is the rental income that you're going to be receiving on your 1, 2, 3, or 4 unit property, or up above that, we can help you with those as well, will actually help you qualify for the property. The only other requisite, those are going to be a few things I'm going to go over, but the only other thing is just having at least a decent credit score of at least a 660. Depends from bank to bank. I'm telling you, with the 660, 680 credit score, you got a good chance of getting approved for this type of loan. Okay, so what are we talking about here? All right, unlike these are some of the positives, right? Not too many cons, I'm going to say, right? I didn't really go over those. What we're looking at here, this is an unconventional loan. your FHA conventional loans, those are your conventional loans, government sponsored loans. These are, in most cases, John, these are private banks or private money from Wall Street, doctors, lawyers, dentists, record label executives that are looking to um, put their money into a product they know that they're going to get a great return from. So they will go to hedge funds. Hedge funds will then put that money into these types of deals and they'll lend it out. Okay, and they'll go through normally like some sort of bank or private bank that my company works directly with. Okay.
Okay. So Joe, let me uh, ask you for clarification. So you mentioned, unconforming loan. You mentioned investor. So typical first time investor, typical first time home buyer, not knowing really too much about the business and how it works when it comes to money and financing.
Mhm.
So you mean it could be a group of folks that, let's just say, they're sitting on some money, they have a bunch of money, they can put all their money together and they're considered an investor. Like, how does that work? Because you mentioned a record label company. It sounds like anybody that has money can basically, loan it out.
I don't know the back end part of it. This is the part, where it's a little bit over my pay grade, but I know that this is money that's coming directly from an individual, unlike your conforming loans, which, you guys can, that's a whole nother show, right? That'll be a 2-hour conversation that's being scrutinized, packaged up, sold into this big investment fund or a bond. This is not those types of loans. This money is coming from regular individuals like you and I, you guys out there in the audience, that's looking to get a good return on their investment. They already got some money in the S&P 500 in the stock market. They got some stuff going through insurance, let's say. They got some mutual funds, and they're looking to, get some additional returns or some more, better returns. So they will go through these banks, lend out their money. The bank then will give them back a return on their investment.
Got it.
So, where were we? Yeah, so these types of loans are very, very, very easy to qualify. I'm not exaggerating. It's less paperwork. Um, Again, the rentals that you're getting from these units, again, 1, 2, 3, 4, 5, 8, whatever, the more the better, right? As John was saying before. Sorry, got the dog noise going on in the background.
Well, the dog can't believe the deal either.
He wants me to get to the down payments, right? So we're gonna get right to the. I hate when you see these videos, or they're all over the place, John. You can get a house with only with the rental incomes to qualify you. How much easier can that be? Well, how much do I got to put down, right? These types of loans are not as easy as they may make them. They make them out to sound. They make them out to be on some of these Instagram reels, YouTube reels, TikTok, and all that stuff. These types of loans, you do have to have at least 20-25% down. Okay? Multifamily option. You can mix this in with other types of deals that the bank or the broker that we're working with directly may offer you, like an interest only for up to 10 years. So that means you're only going to be paying the taxes, the interest, any HOA fees. There's no mortgage insurance on these, no upfront or monthly. So the actual note or the principal of the home, you don't have to pay that. You can mix it in with an interest only loan. Okay. Wow. Questions, John?
Joe, okay, so
how's that sound?
A couple keys. We got a couple keys here. So in case, and just go back to that previous screen, Joe, if you don't mind.
Go ahead, John. Yeah, no problem.
So the master key here,
we jumped a couple times.
Yeah, the master key here is the DSCR loan, right? The debt service coverage ratio loan. That's your master key. On this screen, we have a couple of other keys here. One is you're not going through all the conventional red tape you would in going through your conventional bank, if you will, your regular.
More exceptions. There's
right. You have some things that the
bank is willing to overlook certain things.
Boom. There it is. with this kind of loan, the bank is looking to overlook certain things. Okay, so it's less
Whereas with a
paperwork.
conventional loan, it is what it is. It didn't cut the mustard. These banks are willing to say, well, okay, he, and it's more of the case. Oh, he had a late payment on his personal mortgage. What's going on with that, right? It's not the case of, oh, he missed three credit card payments, or he already has eight mortgages under his own name, which you can do. Oh, we're not. That sounds too risky. Nah, not with these types of loans.
Okay. Now here's the other key. You have here no income. So just rehash on no income. No income for who exactly?
The individual, the entity, it is preferred, John. It is preferred. You don't have to, but it is preferred. I'll tell you the reason why. LLCs are what these banks are looking for. They want you to have them under an LLC. Why? Because for a nominal fee, right? They will actually report the actual debt or the mortgage directly to your tax ID number, and not have to report it to your personal credit. How amazing is that, John? That
That's
you
the
can
major
get
key.
you can have 8 cash flowing properties and not have to worry about any of that debt report to your personal uh, report against your personal income, or reporting against your personal credit.
Major key.
It's
Major
preferred.
key.
They prefer it that way. They actually prefer it. They
Major
will.
key.
It's a couple
LLC.
dollars. It's a couple dollars. We'll leave it at that. It's a couple of dollars. They prefer that it be under an LLC.
Major key.
Real estate LLC. Not, you know, you already have, I don't know, John Johnson's egg farm, right? Because the price of eggs are through the roof, right? So John's
Yeah.
been selling eggs out the trunk of his car like Master P for the last couple of months, right? And he has an LLC. No, it has to be something correlated to real estate.
Less paperwork, no income, as long as the properties are producing enough income to cover the mortgage payment. You can use this program to buy an unlimited number of properties. So you can do as many loans as you want, as long as the properties meet the prerequisite, which is to cover the monthly payment. And you
Yeah,
need
John.
between 20 to 25% down. So in layman's terms, if you're looking at a two, three, four, five family for $400,000, you need $100,000. Am I doing my math right? If we're talking 25% down,
Uh, yeah, just about that.
okay, okay.
Just
What is
about that.
660 credit
Exactly.
score?
Again, with a conventional loan, FHA conforming loans, they're using the debt, your credit card payments, your car loan, um, your student loans. All that stuff goes against you when you're qualifying for a conventional conforming loan. With this program, all that stuff is, they don't even look at it. They don't ask. They don't want to know anything. All they're worried about is that the actual rents for this particular property are a certain percentage over the mortgage payment. I don't think you really
Major key. Major key.
a
Major.
certain, and now that can, we'll go into it in examples, but that varies from bank to bank. And I'm going to show you how it works when you work directly with me. Joe does mortgages.
And don't forget the 660 credit score as well.
Minimum 660. Yes. There is, there are, again, exceptions. There can be exceptions. All you need to do is explain it to me, and I plead your case. I am like your attorney. Package your deal up, present it to the judge, and he will either give you a ruling yes or no, or hey, we can work out a deal. If you could maybe put a little bit more money down, if you could try to help us figure out why you missed that mortgage payment. There why is there a repossession from 4 years ago? If that question may come up. So again, but at the end of the day, John, they want to rent to people that they know that they're going to be able to make a solid investment, because there's a lot of people waiting behind them to get their money back on this deal.
I love it. I love it. Let's see
It's
some
it's
examples
it's
now.
not like it's not like these these banks that will leave unnamed where they just write it off. Well,
Hmm.
we'll write it off. Oh, we got a
Hmm.
$40 billion fine. It's a write off.
Right.
No, there's a lot of
Right.
people. There's a lot of people banking on getting the money back on their a return on their investment, just like these investors are. All right. So
Okay.
this is actually a real life property on. I pulled this from Realtor.com. It's a property in East Orange, New Jersey, northern New Jersey, Essex County. So right now it's being listed for $380,000. Right. I don't know the property personally. I've never visited. I'm just going off what I saw online. That's what you're going to see here in this example. So it's a 7-bed, 2-bath, right? I'm going to split it down the middle and say each one of these units has got at least one bath, right? Got to have that. There's no more. It wouldn't work out of a half a bath, right? One bath on each floor. We'll say 3 bedrooms on one floor, 2 bedrooms on the other. Okay. Now, what I do, and I'm not going to say this is what. Now, the appraisal, there is going to be an appraisal done on the property, right? We want to make sure that it's listed at the right price and that you're telling us that the actual rental, the future rentals that you can, income that you get on these property is conforming to what other rentals are going for that style house in that neighborhood, right? Just like what you would do with on a regular loan.
Now, Joe.
So,
Now,
go
Joe,
ahead.
for our first time viewers, what's an appraisal again? What's the purpose of it again?
The the reason for an appraisal is they're not out to to kill a deal. A lot of people, especially with FHA loans, they think the appraiser is going out to just kill a deal. Essentially, they just want to make sure that the bank is making a solid investment in you, right? That's what you're going to do, and a solid investment in the property. So they're coming out to make sure that the roof isn't about to collapse, the sidewalk isn't cracked, you know, where it's going to cause a lawsuit, or it can affect the foundation of the property. They're going to make sure there's no lead paint throughout the property. They want to make sure that the railings in the front of the house, inside the house, are all solid. Basically, once you move in, they don't want you to say, well, wow, we moved to this house. We didn't know that the bathroom the bathroom's, sink was leaking for the last 4 years, and now the entire roof collapsed on us. That's
Right.
all the appraisal. And then the second thing they're looking to do, they want to make sure that the price that you're making and offering is comparable comps to other properties like the property you're looking to purchase.
Right. And just to add to that, Joe, an appraisal is not the same as a home inspection. A home
Correct.
inspection is a very invasive inspection that pretty much breaks down every inch of a property. The appraisal
Which
is
any good real estate agent will recommend vehemently.
absolutely, absolutely. And an appraisal is a form of an inspection, but it's mainly done on the bank's behalf to protect, like Joe said, the investment in you and the properties to make sure that the property is at least worth the amount that you, the investor, is going to pay for the property.
I'll give you a great example. I'm not sure if a lot of you what was it, right before Christmas or during Christmas, actually, on that week. How many do you have any friends or family that had their house flooded or their apartment building flooded due to frozen pipes,
Unfortunately,
John?
yeah. Yeah,
I
unfortunately, yeah.
had a friend of mine in a brand new building, not a single family residence or multifamily, a building that I saw being built with my own eyes. That's less than 3 years old. The pipes bust in this building because they didn't insulate it properly.
Yeah.
And this is the type of things that is why you want. It's not mandatory from us in any free conventional loan or these non-conforming loans. Not uh, It's not required, but it is always highly recommended, especially in these older style houses. Or as I was just giving the example, even in a newly renovated house, they may
Yeah.
have completely done the inside of the house, but God knows what's behind those walls.
Right. Right. Okay. Back to our example, bud.
So we're back at 530 Norwood Street, East Orange. Okay, so I went over the bed and bath count. So the list price is 380. I came up with a mortgage of $3,118, right? That's what that's what someone putting down 20%, right? The minimum is 20%. It could be a little bit more depending on the deal, right? Every deal is not exactly alike. Now, based off I use a website, John. I'm not sure if you're familiar. I used a website called Rental Meter.
Okay.
Um, Let me show it to you here. It's pretty cool. I pay for the professional version of it, but they give you a few rentals for free. And you guys, I'm not sponsored by them. Just showing you what the way I do it myself. I just go here to Rent-A-Meter. I put in the address of the property. I put in the bed count and the bath. The max you could put the bed is 1.5, and it gives me different uh, about four different. It gives me a median, a high, and a low point for that style house in that particular area or zip code. All right, so that's what I was using. And with that being said, I came up with a monthly rental of 3,150 for both floors. So you still have to account for your utilities, water, electricity. That stuff's not free, right? Just because you're an investor. Now, this is where it gets exciting. Depending on the bank, like I was saying earlier, dog's excited again. The ratio that comes back when you divide by the monthly rent by the actual mortgage comes back with an actual interest or percentage. Okay, sorry, I jumped ahead. Comes back with a percentage. Okay, this one came out at 1.01. With my bank, this would qualify, which means it's zero point 0.1 above what the mortgage is. It's a dollar amount. So essentially, as long as your rental income is $1 over the mortgage payment, the future mortgage payment, and your future rental income, you will qualify for this loan. Now, is it the best advice that I could give you? Or I'm not going to give you the advice. I'm not a financial advisor. That you want to still take into account the utilities that you have to come up for. There's capex expenses. The roofs can collapse. Roof needs to be repaired. Sanitation things come up, right? Maybe you want something with a bigger spread, but that's all up to the investor, John. I'm sure you're familiar with that.
Absolutely. And just breaking this down, um, and for those of you that are renting, you're probably looking at the rents of 1,550 and 1,600. Like, okay, where is that? Let me give John a call. Uh, you know, these rents are probably rents that have not been raised in years. Because I'm sure you, the audience, know that the rental market in East Orange for a 3 and 4 bedroom, they're well into the 2000s. You're talking 2,300 and up, starting for a 3 bedroom. But even still, with these low rents, you still qualify for this kind of program. And depending on what your strategy is as an investor, utilizing this program to, let's say, purchase this home, you may see it as an opportunity to increase those rents, over the years, over the next coming months. You don't know the situation with the tenants there. Maybe they're looking to move out. Maybe they're on a short lease or what have you. So there's an opportunity to increase those rents to profit even more. And the other thing, full disclosure, by the time you guys actually, see this episode, this property is going to be long gone. I'll be more than happy to find you something similar, and I'll get you into this program.
Just wanted to use some again. These are real life properties with estimated values where we're talking about the rentals and what the mortgage payment will come out to be. Right. I think something someone's definitely going to bring up. Where are the interest rates for these things? Right. These interest rates are maybe about a point to a point and a half, maybe even 2 points higher than what we were looking at a little bit earlier on the show. These are riskier loans because someone that's not going to live in the property is not going to, not to say you're not going to care for it, it's yours, you put your money into it, but someone that lives in the property can take a look at it every day. These are a little bit riskier. So the down payment's going to be higher. The interest rate's also going to be higher. But there are options for you to buy down rates. Again, these loans aren't all identical. You call me directly, say, Joe, I got a property that I'm interested. I got my 20% down. Where can I fill out the application? Then I'll give you back the results and say, hey, this is exactly what we need. We already have, or I need additional information in order to get you qualified. But the
And
rates are a little bit higher. With anything, that's when you're dealing with business. When I had a restaurant, sorry to cut you off, John. When I had a restaurant, and many of you that may be you're self-employed, I'm sorry, you're business owners. You may have a luncheonette, a bar, uh, uh, a hair salon. As soon as you put that business name on the Verizon bill, guess what? It's not the same rate that you're going to get as a residential cable bill.
Mm-hmm.
Internet, the same. Insurance, the same.
Mm-hmm. Yeah.
I'm sorry, John. You were saying something.
Yeah. Yeah. You made a reference to a point higher. So let's just use the examples you used in the beginning. If conventional or FHA is at 6.25%, what does an additional point mean? What does that mean?
1 point is an interest rate. Good point, John. 1 point is 1% higher, or just 1%. So if I'm saying it's a point or two, it's about 2% higher than what the conforming loans are currently at.
Okay.
And they don't base it off of that. They have their own formulas that they're working on. Again, remember, these are all investment loans or investment deals. They still have money to return back to the investors. So there's a lot more layers to it than with a conventional loan.
Yep. Gotcha. Okay.
All right. So that's East Orange, which is most likely gone, but you can call John. And at Exit Platinum, you could definitely try to find you something similar. So this number two, this rental here is actually this property here is a little bit more near dear to heart because it's here in Union County where I'm located. And some of you guys may say, "Whoa!" when we get to the monthly rental income, but check around. So this is 14 Ludden Street in Elizabeth, New Jersey. It's listed right now for $700,000. That's not 700. It's missing a zero there. Sorry, $700,000, and it's a 5-bath, 7-bedroom. So again, I split it down the middle. I said, hey, I went to Renometer. I said one unit's going to be 3.5, 3-bed, and the other one will be a 4-bed, let's say with 2-bath, right? So I mixed it around a bit, maybe throwing off the numbers. So with 20% down, your monthly mortgage payment, again, principal, interest, taxes, no mortgage insurance, would be $5,823. Whoa, Joe, that's a crazy number. All right, but this is what Rentometer is saying, or this is the information they're gathering. 8,558 is what you could actually get in rent on this property. The ratio for this one is 1.47, way above the mark of 1.01%. This is real life example, guys, in Elizabeth, what current rents are going for. I'm not sure how many of you guys are familiar with Elizabeth. I think, from my perspective, it's definitely an up and coming neighborhoods. It's an up and coming neighborhood where properties like this were selling for 400,000, John, 5 years ago.
Yeah. Totally get it. And Joe, in case people are looking at the slide, they might be focusing on, or at least I am, the monthly rental income total. So you have two numbers, 3,300 and 2,600. Now
that's what I broke it down. Yeah, exactly.
Okay, so I would assume with those two numbers, those are the two occupied units, and maybe you have a vacant unit to make it equal 8580.
What do you mean for like one of the currently?
Right. So I see the monthly rental income total. You have 8580, right. And then parentheses you have 3,300 and 2,600.
Yeah, that's what I pulled from Rentometer. That's what they're saying, that the first unit and the second unit could be rented out for. I think I made it the second unit when I plugged in the numbers. It was probably like a 4-bed, 2-bath on the second unit.
Okay.
And then I adjusted the first unit for 1-bath and 3-bed.
Gotcha.
I think that's is that what you were asking? Is that what you were trying to make clear? Yeah, that's what I plugged in there. Now, these rentals, I'm not saying these are exactly what the rentals are. You want to, contact your local real estate professional for that information. But these are good, solid averages of what rentals are going for in Elizabeth. Yeah. Why? It's 30 minutes into Manhattan. There is a ferry being built as we speak that's going to be getting people from Elizabeth to New York in under 30 minutes. I don't know what it's going to be, like $3 each way. something to that nature. It's only 45 minutes with no traffic into New York from this area. So I'm not sure with native people from New Jersey think about Elizabeth, but it's definitely up and coming. In just the last few months, they've built about 10 new residential buildings in this area.
On and popping, man, closer to the city. Yeah. So,
And
Joe, show us
It is not
scenario.
Jersey City. It's not
Yeah.
Hoboken, where it's already been exploding over there. I think those things have capped out. This is just Elizabeth is just starting to get started.
Yep, starting to go a little deeper into Jersey.
Absolutely. So my last example, all right. So this one here, as you can see, you already see the X mark, right? This one didn't cut the mustard. So this is 28 Van Fleet's Court in Clifton, New Jersey. It's listed at $699,000, according to Rent-A-Meter. And I think, John, you were looking at this previously. I think you said the rentals may be a bit off, but the mortgage payment on this property with 20% down would be $5,896. Again, we're just using an example, right? Real life properties, just examples on the numbers, right?
Mm-hmm.
According to Rent-A-Meter, we could get, for both units combined, we can get about $3,700. So this, as you can see, easy math. The actual rental divided by the mortgage payment gives you this percentage. Since it's less than 1%, it's not a dead deal. But you may have to put additional money down. Maybe someone with a stronger credit score. Maybe we have to, like I said at the very beginning of the podcast, we can maybe add in an interest only to try to get you closer to that 1% mark.
Loving it. Loving it. And Joe, if I could just wrap up, the master key is this DSCR loan. You reach Joe Does Mortgages, to see if there's a property that I may have found for you or another realtor has found for you that meets this criteria. You have a minimum credit score of 660. You have to put it into your LLC, and that LLC will be the one that will have all the reporting done against it versus your personal credit report.
And you can do multiple LLCs.
What's that, Joe?
You could do multiple LLCs for each property.
Multiple LLCs.
One thing that I had on my notes that I want to skip over. This might be a question also people are going to ask in the comments, or they may call you. You can use this with Airbnb where available. Where available.
Another major key. The 25% down. I mean, you can buy as many properties as you want with this program. And as long as the rents cover the principal, interest, taxes, and insurance, and you have the 660, you have the down payment, you got an investment property.
No tax returns, no W-2s, no having to explain your overtime and all that other good stuff.
Think about it this way.
Easier. Can't get any easier, John.
It can't. And think about it this way. You would only get approved for the property if it's already going to make you money. Think about it that way. There's a program for you.
We don't go into opening a car dealership because I can't wait to have to wreck my brain how I figure out I'm going to make money every month.
This is a great program. Joe, how do they reach you?
908-669-9091. 908-669-9091. You can DM me here on Instagram, Joe Does Mortgages. John, how are they get in contact with you?
Hashtag Johnson Signature Group on all platforms, all over the web. 908-338-0639. If you have a question about what are the rents looking like in your area, if you're looking for a multifamily investment property that would fit this program, if you're sitting on some cash because you were really smart during COVID and you made some moves during COVID and now you kind of want to put your money into a vehicle that's going to make some money for you while you sleep and maybe pay an interest-only loan on it, as Joe has explained, reach out to one of us.
Absolutely, John. This was awesome, and I hope you guys really got some great information from here. If you really just want me to go over some numbers with you, please reach out. I'm always open. I try to make myself available as often, or I'm taking calls all day. If you just want me to shoot some numbers, do a soft credit checks, Joe, I've got the down payment. I don't know where my credit is. I know I'm not supposed to be using Credit Karma. I'm not supposed to be using Vantage scores, because that's not what the mortgage companies are going to be using to qualify me by. Just reach out and I'll be more than happy to help out.
Awesome. Well, this has been another episode of Real Estate Keys. Keep the master key in mind. Keep the rest of the keys in mind. Until next week, see ya.
See you next week, guys.